Good morning. This is Jim Colburn of Commodity Research Group. I'm here with Andy LeBeau, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website, commodityresearchgroup.com, where we post our podcasts and blog. We would like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is June 17th. And Andy, we had the big three, the EIA, the IEA, and OPEC come out last month. And if you looked at least the EIA, it looks like their biggest revision was on prices. Prices rallied. They didn't have that in their forecast. Why don't you tell us what happened?
Well, good morning, Jim, and hello to all our listeners. It's been a very interesting month, I think, Jim, since we last talked. The market has been on quite a run here. Brent reaching $75 and TI reaching 73 earlier in the week, and I think many traders and analysts believe that the run isn't quite over. I think the impetus certainly has been the expectation of stock draws coming up. We've had stock draws right along since mid-June last year, but it looks like those draws can accelerate in the second half as demand really ramps up, and we'll talk about that certainly. Secondly, the market had been anticipating, or some analysts and traders had been anticipating that Iranian barrels would be on the market, as soon as July. And with the recent talks, it looks like that is probably not gonna happen. And those barrels may not come till may not come out till October.
Andy, that was that was in line with what you've been saying for a while. Right.
We didn't see them coming out in July. I mean, there could be a last second miracle, but given that the Iranian elections are coming up, I don't. It's hard to foresee those barrels coming out before October. I think they will do the deal. I think they will come out, but in any event, those people who thought that they were coming out sooner, it had to either cover their shorts or reassess where the market's going. And we're seeing that actually just looking at this at the commitment of traders, or obviously we look at that all the time. And you look at what happened in WTI, and the longs to short went from a couple of weeks ago. WTI was 10 to 1 on May 4th. It's now 15 to 1. And, the net length has really increased. So it's also become a very popular trade, being long oil, in line with some of the moves in other commodities. But I think the main, to us, Jim, you and I are we're dyed-in-the-wool fundamentalists and barrel counters. The market's in deficit, and it really looks like that deficit's going to increase, over the next couple of the next 2 quarters. So, I happen to think this price, it's probably fair. The question is how much has already been discounted, and that remains to be seen.
Right. And maybe we could go into the recent OPEC meeting and talk about what they're seeing going ahead and their plans for increasing production to make up the deficit or not.
Right. Well, they have the same numbers as as we do. I think their demand estimates are probably a little, the OPEC and OPEC, they both put out different numbers, but they're more or less the same. Their demand estimates are more aggressive than ours are, Jim, not surprisingly, because look what they,
Yeah. Talking their
look
book.
what they produce. Yeah, they're talking their book. But nevertheless, they're seeing, if you looked at OPEC's call for OPEC crude in the second half of the year, it's pushing 29. It may be actually over 29, and they're producing 25.5 now. So that they know that they're gonna need to provide the market with more barrels. And let me look at what their call is. Yeah, I mean, it's pushing 29 million barrels a day for the call for their crude.
So,
And but they're going to increase by they're going to go from 25.5 in May to 26.3 in June. And then in July, they're probably going to go, they're going to 27.1, which is in the OPEC plus balances. And I think it's part of their deal that they made last year. So they are increasing production, but it's not going to be enough to meet the demand.
So the EIA came out last week and suggested that there would be enough that we do reach a balance in the second half of the year. So they're looking at consumption up from the second quarter up 2.8 million barrels a day,
right?
And then production up 4.3 in the second half. And they have draws at 1.5 million barrels now. So I think that yields a balanced, supply demand balance in the second half of the year. Are your numbers coming up similarly?
No.
I knew that.
Not.
I knew that. Yeah.
Well, what the EIA did is that they cranked up OPEC production, right? Which could happen.
Right.
I'm using my best case here. My best guess. They could, again, that's going to be that's going to be price directed and geopolitical directed. I mean, there's a lot of things coming up for OPEC plus that we'll see where they come out. Just using their numbers though, and then adding a fourth quarter increase from Iraq. My numbers are draws of about about 1.718 for the second half of the year, and I'm on the low side from some of the other expectations for second half. EIA, they have balance because they just said, well, OPEC's going to increase production because A, B, C, D, the prices will be high, and they might. The EIA might be right. There's some big decisions coming up at this next OPEC meeting on where they're going to go on production. They certainly got a break not having Iran on the market. But even if Iran was on the market in the third and fourth quarter, let's say Iran provides an extra 1.5 million barrels a day. Okay, I have actually 500,000 for fourth quarter, but they probably can come out quickly with 1 million barrels a day if you throw storage in there. But if that's the case, then the market would be more balanced, and certainly prices would come off. But they might be able to live with that.
So you're thinking, say by 2022, we're going to need those Iranian barrels.
By 2022, we are going to need the Iranian barrels. Yeah, we are going to need them, and we're going to need more supply from OPEC because demand is still going to grow. 3 million barrels a day. So we are going to need some extra supply from OPEC plus, from Iran, and from non-OPEC producers.
Well, it was interesting from an option standpoint. The OPEC meeting, I think it lasted about 20 minutes,
right?
And vol was already trending lower into the meeting. I think we had been up around 37%, and coming out, we continued to trade down to 30% or so. And it's also that, volatility doesn't, it tends to go down in markets that go higher, and the trading ranges are kind of, more less. It was less volatility in the actual market as well, so that kind of pulled it down. But it was just interesting. I wish, if someone had told me that the OPEC meeting was going to be 20 minutes long, someone who is not comfortable selling commodity volatility would have been all in on that one. But yeah, it's just we don't always know what's going to happen. But the other thing I'd say is that, we yesterday actually we saw we've been you and I have been talking. I think it was maybe the March podcast we did. We started seeing $100 call buys in December of 2022, which was really unusual. And then recently, I think it was Wall Street Journal came up with an article last week about all the $100 call buying, and most of it had taken place, 2 or 3 months ago. But yesterday we saw some 110 and 120 calls being bought in December of 2022. So that $100 call is still the biggest open interest on the board, 60,000 lots. So it's still the biggest one. But what happened, would you say, recently that might, listen, that could be one crazy trader doing that, but what would make somebody believe in $110, $120 oil, say, going forward?
Well, I think that, first of all, can we get to 110 or 120? As we've said many times, anything's possible. I didn't really think 100 was going to be in play. And I think that what's happened is, well, I think a couple of things, Jim. One is this idea that, all the capital that's going into green, it's not going into black. It's not going into oil. And as a result, some big projects may not get okayed, and we know there's depletion of 3 or 4% every year. And as a result, oil is just going to get tighter and tighter. So I think there's that idea. And then there's the idea of, the inflation and the whole super cycle. And I mentioned how this speculative money coming into crude. So I think that there's that. People believe that crude may be part into the super cycle. And finally, well, not finally, there are a lot of factors, but let's say the Iran deal isn't, Iran doesn't come onto the market, and there's any kind of geopolitical upset. We're already in terms of inventories, we're already on the tight side. So, well, we're below average, I guess. Well, we're tight, actually, if you look at the curve, Jim.
Yes.
Right. So, we're below average. I had us going into below normal by July, but we may well be there, looking at what's happened to the curve. So inventories are tight. So any kind of geopolitical upset, that's a big problem. That could be a big problem. So it's not, we lived through 147 back. When was that? 08?
Yeah, 2008. Yeah.
Yeah.
Which to me was, I had this, as a long-term argument that, maybe instead of looking at the economy under presidents, we should look at whether it does well or not, and give credit to a president. We should be looking at oil prices or energy costs, because, when you think about Gulf War I, when prices went up during George Bush's senior's tenure, we had a recession right after that, and then 2008 we had oil prices go up to 147 in WTI, and we had a major recession after that. So it's kind of like you think about Jimmy Carter. We look back at those economic days as being sort of awful, and he was there during some huge spikes in energy costs. So I guess my question to you would be, are we at $75 oil, are we starting to set the seeds for the next decline in oil price, or do we still have a way to go before we do that?
Well, that is an interesting question, in because I think what you're really talking about, Jim, is where is the U.S. producer? Because we were we've been the marginal, we had been the marginal producer. We had, over the last few years, we're the ones that you know lent extra barrels to the market. And at what point does the U.S. producer throw off? They have, I think, as both of us discussed earlier, and many people have mentioned, you and I have been dealing with the U.S. producer our whole, for 25, 30 years. And I think both of us were sort of shocked at how disciplined they've been.
Well, even the EIA's report made a comment that their models suggest that there is discipline going on. So they basically were saying that at current prices, I think they have a 3 to 6 month lag between price and rig counts. They're saying the rig counts, even though they've come, I think they're double off the low.
Right.
They've come back. They haven't come back as fast as they would have expected in their models. Now that could be, how much experience do the models have? They could be, there could be problems with the models. But I'm just saying that there's another piece that they're showing more discipline, and I actually thought they would be, scooping up these $50 and $60 puts in December and producing, or out a lot and just producing like crazy, but it's not
They
happening
haven't
yet.
been. I mean, it may have started. I mean, if you look at last week's weekly EIA number, they were up to 11.2, a big jump of 200, and that was onshore. So that, maybe it's started, but there's certainly a lot more room, obviously, for U.S. producers to start coming up with with some more barrels. And
Interesting, Andy, you bring up the weekly number of production because, you always talk about how the EIA's weekly update is a 1 week number, and you can't, you're better off looking at, say, a 4 week average. But this week's report had some really eye popping numbers in that. I mean, I looked at it as a very bullish report. And another thing you said in this recently is how much is in the market, and the market's not reacting. I mean, it's not collapsing, but it's kind of moved sideways, I guess, from that report. What can you just kind of tell us what you look at when you look at these weeklies, and what was interesting about this week's report?
well, this week's report had, yeah, I thought it was a really interesting report. The market has been, looking at gasoline demand, which has this week's was, what was it, 9.3,
Yeah, it's
9.4.
9.3.
Yeah, it had popped up from poor week last week, but also, there's another component, which is the production side, and we are producing. The gasoline output is a little higher than I thought it would be for this week, but not all that much actually. It's the import number that's really been is something to. I'm looking at that actually, Jim, also almost as carefully as everything else, because the imbalance in gasoline, which grew, it's grown 9 million barrels now in the last couple of weeks, and we're just importing too much gasoline. And then you think, the way that I look at it is, I try to project the numbers going out, and, looking at where the production is, that's growing a little too fast. But gasoline imports should decline coming up. I mean, a lot of this is still from the spike that we saw as a result of Colonial. Europe sent us all this gasoline. It's still going to come, I think, but at a much lower rate. And importantly, we're going to export more to South America. We already are. There are refinery problems in Brazil, and Mexico's demand is beginning to tick up. So, I think gasoline's going to draw here. But the other thing I look at is where are we relative to the 5-year average? We're
Hmm.
high, and the 5-year average I use is 2015 to 2019, because last year was so off, it
Oh, of
was
course.
so out of control
Yeah.
that you got to just on both supply and demand, you got to just throw it out. But gasoline just went in 2 weeks. It went from looking okay to looking, somewhat worrisome. But we're 2 days supply, and day supply is stocks divided by demand. We're 2 days supply above the 5-year average. We have been running like half a day to a day. So the last 2 weeks has done a lot of damage for gasoline. And look what happened to the cracks.
And they
You
fell
know,
apart.
it fell apart.
Yeah.
Yeah,
Well, Andy, I saw the runs were up
right,
412
right.
to 16.3,
Too
and
high. Well,
that's
not
too.
too high, not too high. Much higher than where the EIA had it. Actually, higher than what I thought it would be for this week too. And that's margins were okay up until the last week or so. Margins were good enough to run.
It's
And
almost, you're almost looking at who's doing a better job at managing supplies, at the producers or the refiners. And it's like the refiners they see good margins, and they come back, and then all of a sudden the margin they go away like snap of fingers.
right, right. Well, they had been doing a pretty good job over the last year or so. Not year or so. Let's say 6 months. They've been doing a pretty good job. They got some help from the hurricanes and from they got
Oh yeah,
the hurricanes and the big
cold,
freeze
the big freeze, right?
kept production lower than it ought to have been. Else they would have screwed this up months ago, I think.
Yeah,
knowing knowing refiners, right? They'd be
yeah.
like, oh, all right. Well, the other thing is they're expecting big demand too on gasoline.
Well, if you get back to that gasoline demand number 9.3 for this time of year in a normal year, if that's possible, that's not a bad number, right? I mean, as long as we keep going higher.
Yeah, 9.3. The 5-year average is 9.55. So
For
nine
this,
three
okay,
is not horrendous,
not horrendous.
and I think it's going to keep going up. Some guys are looking back at maybe the market getting the 2019 numbers 9.6, 9.7. The
Right.
EIA is low; they're at 9.2. The government is looking at 9.2 for June, July, and August, 9.2 million barrels a day. We're closer to 9.4, but there are other guys who are looking 9.6, 9.7. Maybe it'll come in there,
So
maybe. I mean,
I
people want to drive. They want
yeah,
to hit the road.
yeah, I'm optimistic on, that maybe, listen, as you say, it's a 1 week number, but I think this is like the beginning of a pretty good gasoline season. And I guess my question is, there's still excess capacity for refiners, and what's gonna happen first? Are we gonna see a pop in gas demand, or are we gonna see refiners come back? It's just I'm guessing that I think the refiners are going to kind of come back to meet the demand. So I'm not. I guess what I'm trying to get at is there a play in the gas crack or not? I don't. It's as you mentioned. It was decent. It was good, and then it came off sharply. And then does is there enough gas demand out there to take it back just so you know to bounce off of these levels?
Yeah, as I was saying, I think stocks can draw from here. A big thing will be, if export demand really kicks in, refiners want to send, they prefer to send barrels out. There's the RINs, the administration's working on the RINs issue. I'm sure they'd love to see the RINs come off because that's also been holding them back. If it does come back, though, then they'll crank. Then they'll crank. So it's really, gasoline should be pretty interesting coming up. And of course, imports I think are also going to come off.
So
So inventory should draw, I think, from these numbers, but is gasoline going to get tight? That I don't know.
So
I'm not sure. I don't, unless demand is like 9.7, 9.8. I don't see it.
So a lot of these numbers for the weeklies are estimated or backed into, but the stock levels are surveys, correct? Is that those are
Right. The stock levels are usually right.
they're usually right. So so going forward with all this noise in the marketplace, what kind of what are you looking at? I mean, it sounds like you're looking at all of them, but is there any things that stick out that you'd be interested? You said gasoline imports you'd be watching.
Yeah, gasoline imports will be important to watch. Distillates, I'm watching the production because it's much too high, but demand's been solid for distillates. Diesel demand's been really solid, and
Ask anyone who's been on the highway in the last few months.
oh man,
It's like trucks all over the place.
all over the place. I mean, it's like a parade of trucks.
Yeah.
And I think so, which is the reason diesel demand has been good, and we know that it's been good even with the all the supply chains messed up. So I think that'll continue. Interestingly, distillate day supply is 34 right now, and the 5-year average is 34 and a half. So we're in pretty good shape on distillates, but certainly that production number bears watching. And total demand, we are running the 4-week average is 19.35 million barrels a day. The 5-year average is like 20.24. So we're still 900,000 barrels a day below average. And a lot that is a function of gasoline demand not where it could be, and jet fuel demand is still running 400,000 barrels a day below average. And that should I think that'll improve.
What was the demand number this week, or as they call it, product supplied?
It was over 20 million barrels a day. It was good.
Yeah. Again,
It was
number.
good. Yeah, for a 1-week number, it was pretty good. I mean, it wasn't the 21 that we've seen, but it was good. It was good. It was good across. It was good across the board.
Before we get into talking about prices going forward, any other things that you want to talk about as related to fundamentals?
Well, I think it would be interesting to see. One thing we can talk about is whether or not the administration, where at what point, is higher gasoline prices a problem? A political problem. I don't think we're there yet. And the other thing related, Jim, is what's the demand effect? Is there going to be a demand effect if prices start moving up to $4 a gallon or 3.75, so somewhere in there. I mean, it's usually 4 is usually unacceptable.
Right. Except in California.
Yeah, well,
Yeah.
right, except in California. But
clean.
I mean, for the rest of us.
Right. Yes.
And I think even in California, and do you think there's going to be a price effect, or are people just, it doesn't matter?
Well, there's also the income effect. So people, obviously not everyone, but there's if you look at the economy as a whole, there's more income in people's people saved a lot of money last year, the ones that could, and so that tends to have a countervailing effect on the price. I think we saw that, in previous moves up in gasoline prices, as long as people's income keeps going up. So that might be an offset. Plus, the wild card is the pent up demand. I mean, anecdotally, we seem to know people and see it on the highways that people are wanting to get the heck out of their houses, and and I think people who can work remotely are looking at Airbnb type situations where they can work from places that aren't at home. They can go on a trip and still work.
Right.
And
Right.
we still haven't seen the kids out of school yet. So I think there's anecdotally, I think the parks are full, in terms of trying to get a reservation.
I
So
don't think you can.
I don't think you can. And so I think that, I'm kind of optimistic on this gasoline demand. I don't want to say it at any price, but for where we are now.
Yeah. So we may just see. Yeah, it doesn't matter where the prices are, as long as they're not four. As long as it doesn't have a four handle. But
Yeah.
I don't think it will. I mean, could. Well, I shouldn't say that. I mean, it could. Anything's possible.
And it,
And whether or not whether the administration gets involved in oil pricing, I don't know. I mean, they're working on the RINs issue, and that may bring more supply. Whether they go, as far as putting some pressure on the Saudis. I don't know if they're up for that right now.
yeah. We haven't talked about China. You want to mention?
Right. We didn't talk about China,
So
which is obviously a really big deal, being that they're the second biggest, second biggest consumer of petroleum, and that their it looks like from their apparent disappearance is doing very well. Way ahead of last year, but of course last year in the first quarter, they had their outbreak. They had their virus outbreak, and it looks like they're up over 1 million a day. I think some of the estimates for Chinese demand is going to be, could be close to 1 million a day. I'm working with around 7 to 800,000 a day growth, and their imports. It looks like they did great last year because they bought. They did what you're supposed to do. They bought, like, when the market was really on its heels, down around, with TI, TI from 0 to 20 and Brent from 0 to 20. They bought the hell out of the market,
yeah,
and they built up inventories, and it allowed them to draw down inventories in April or May. It looks like they may continue to draw inventories, or are they going to get squeezed with prices up here? They usually don't.
yeah. Well, I guess we always wonder if it's when they're buying crude, whether it's crude to consume or crude to store. And at these prices, it's consumption, not they're not.
Consumption, right?
Yeah, they're
So
not.
they're certainly not going to overbuy.
Right.
They may work off some of the inventories some more of the inventories that they built.
And
So yeah, that's a tough one, but it does look like their demand is picking up.
it's picking
And
up. And
what's really important, I think, is to watch. Are they buying up here? Because obviously that's pretty bullish.
right, right. And they certainly are. I remember from my grain days, they are savvy traders, like you just mentioned. And what about India? Are we seeing a big collapse in demand in India, or no? Because
Yes, I mean it's well, demand is definitely softening. Obviously,
Mhm.
they were expected to grow from last year by over some people had them up 1 million barrels a day on demand, up from 4.5 to 5.5. I think the OPEC took that down to 500 a day growth. So they took off 500 a day, which is a lot, and that is we've got them at around 4.8, 4.9 this year. So there's still the demand's okay. I mean, it's not okay. I'm trying to be.
It's not the worst case scenario that's playing out.
Yeah, it's exactly. Thank you, Jim.
Yeah.
Thank you, Jim. And
So let's wrap it up with like prices going forward. Just like a month or two out. It's
well,
tough.
it's a tough call. In our last monthly, we had WTI at 73.50 for the next month or two, and Brent at like 75.50. We're just about there. can the market appreciate? Yeah, I think there's still some room for the market to move up. I mean, there's a lot that's going to go on here in July. You know, this OPEC meeting, you know, where they go on supply. The Iranian election, you know, is going to be a big deal. The talks are going to be a big deal, and you know, those are going to start telling the tale, as is any kind of price, you know, any price effect from these higher oil prices. You know, I think there's some more upside, but you know, you start getting an 8 handle ahead of Brent, and you know, I think that's sort of toppy up there.
Yeah,
Particularly, the other thing to watch is going to be these U.S. producers. You know,
right.
and some of the chat coming out from you know, I'd watch what Scott Sheffield has to say over the next month or so. You know, because he's been the leader on the discipline. You know, we're disciplined,
Right.
but as we've said in the past, you know, these guys are, you know, they're into the exploration and production. They're producers. So you know, let's start watching the chat and the actions from some of these U.S. producers. If you start seeing open interest really start spiking, you know, in the you know, some of the puts you mentioned, Jim, or you know, some of the outer months, you know, that also is bearish.
Right. And what about products? Gasoline, we expect to do what?
I think that I actually like the cracks, so a little, you know, I'm not sure
Mhm.
I'm ready to buy them right here, but yeah, I think gasoline is gonna, again, you know, you start see we'll see where these demand numbers come in,
Right.
and what refiners, you know, how they produce. We've come out of turnarounds, so you know, those are over. But yet we're also seeing with the spike in power price and with the spike in heat, where you know, Texas is having issues again,
Right.
and we've got hurricane season coming up. So, you know, global warming or climate change or whatever you want to call it, you know, is definitely having an effect
Hmm.
on supply and demand of refined products.
And
Diesel has been, I think diesel still do okay. And I think margins, which have come off, I think they're going to stabilize and should start coming, you know, drifting back up.
all right. So I have to tell you that I agree with everything you said.
All right.
Anything else you want?
It's just the two of us.
I
We-
know. I know.
Well, we'll
Uh,
get, you know, we'll be looking to get a special guest coming on who can, you know, argue the other side or agree with us.
yeah. I think it's amazing how when you read one of these monthly reports, including your own, within weeks, you know, like I think this time over the month was how much prices moved up, but also the since the beginning of these reports, the cracks have fallen apart. So it's kind of
Right.
like something always happens as soon
Something
as,
always happens.
yeah, which makes it very
And
interesting.
let's not forget, you know, we still have this, you know, this virus throughout the world,
Right.
and you know, some of these variants. So let's, you know, let's not forget that. I mean,
Yeah.
we you know, looks like we've come to the, you know, the light at the end of the tunnel. Is we're just about there here in the U.S., but you know, there are other countries that are well behind us.
Yes. Very good. Okay, Andy. Thank you very much. Anything else you want to wrap it
Yeah,
up?
let's, you know, if you want to get a hold of us, you can get a hold of me at alebow, ALEBOW, at commodityresearchgroup.com, and our website, Commodity Research Group.
And you can find me on. The best way to get in touch with me is on LinkedIn. So you just look me up.
Yeah, I'm on there too, on
Oh,
LinkedIn.
okay. Thanks, Andy.
All right. Thank you, Jim.